Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
I'm Hamsini Karthik, your host for this edition of the State of Economy podcast on finances. Well, we did take a bit of a long pause on this topic, and I'm sorry, because that's also because we had to find a very good topic to talk about. Well, we have with us today Aurodeep Nandi, who's the Indian economist and vice president of Nomura. Aurodeep is here with us to talk about what sense to make of inflation numbers, how to really read the growth data that we're seeing, and etc. There's a lot of optimism in the air. But how much of optimism can truly hold water? Or are we building scenarios ahead of them really panning out in reality? In fact, to decode whether we should look at numbers with a little bit of caution is also another reason why we took a little more time to come back to you with a good edition of podcast. Now listen into this conversation with Aurodeep Nandi. Thank you so much for joining in for this edition of the State of Economy podcast. It's a pleasure to have you with us, Aurodeep. And we look forward to breaking down some parts of what came out a couple of days back from the RBI as minutes of the MPC meeting. This is one of the few times where the members of the MPC unanimously voted in favor of rates to stay at 6.5. We've had a little bit of dissent in the past. How do you read this unanimous calling to 6.5 as that inflation is stubbornly high, inflation is going to be stickily in the current range? How do you read it?
The way to look at it, in my perspective, would be that there is more consensus within the MPC on how inflation, how the inflation trajectory is, the inflation risks are, and two, and very importantly, is sort of how to tackle that inflation. And I think whatever divergence there is will probably be on the margin in terms of where the growth outlook is. And I mean, to be honest, this has been, there are some remarkable parts of the inflation jigsaw because, we had a sharp rising inflation in July. Right, in June, July, at the time when tomato prices sort of hit the roof and maybe just, went through the roof. And then the concern then, and if you've been looking at sort of the prices since, yes, tomato prices have come off, but very lately you have onion prices again starting to pick up. And I guess the worrying aspect is also that the broader food basket, right? So if you consider things like cereals, like pulses, like spices, eggs, these have also gotten pretty expensive. Now, overall, so this tells you that food inflation is elevated. But the reason why, it's an interesting enigma is that despite higher food inflation, inflation expectations have actually been remarkably well anchored, right? So and inflation expectations, by the way, is a very important input that goes into the way Monetary Policy Committee thinks about about what it wants to do on policy. So household inflation expectations, I think in the last policy came down to sort of in single digits after a very long time. And we've also seen sort of core inflation sort of capped. Now, I mean, the thing to understand is that how is it that an RBI, or as a matter of fact, any central bank, how is it that they are going to counter higher food inflation? After all, the RBI is not in the business of going out into the fields and growing crops. The way the RBI or any central bank deals with this is to say, all right, these pressures have happened, which is independent of what we do. But what we really want to prevent is what in economics is known as generalization of pressures. So higher food prices kind of spill over to higher prices of other goods and services, which then would mean that the RBI would need to hike policy rates to sort of bring down the level of the momentum of growth to control prices. Now, this is theoretically how it should be. Now, what has turned up is that inflation expectations haven't been that elevated, right? So if inflation expectations are not elevated, the second round effects, or rather the spillover of higher food prices onto the broader basket hasn't really happened. And given that is the case, the MPC has much more confidence around inflation, saying that, look, yes, inflation went above our upper tolerance level of 6%, but as of September, we expect it to, and it as they correctly forecasted, inflation sort of came down below their 6% mark, and we look through this. We will respond. And it's, I mean, one of the things that has been characteristic of MPC's communication, of Governor Das's communication over the past several meetings, as a matter of fact, is sort of to say and underpin the fact that, look, inflation is elevated. It's still a problem. We still need to tackle it. We can't let our guard down. And I think that message is sort of being recurred across. So that's not being diluted. But all what the RBI is saying is that, look, if these are transitory shocks that are happening, yes, there is so in the MPC minutes, they did mention that, look, if you have a number of these shocks sort of come one after the other, that's not a good thing. That is difficult to manage. But, for given the levels of shocks that, given that these are supply side shocks for now, there is, and given the fact that inflation expectations are anchored, core inflation is not rising. In fact, every month we see it moderating. So there is no need for us to raise interest rates at this point. And external MPC members have in the past and continue to say that, look, we are looking our real interest rates. So essentially, the interest rate now minus sort of the inflation 1 year ahead, they are at optimal levels, and we really don't want to raise it anymore, which could then jeopardize growth. So I think in that perspective, the MPC seems to be coming to a sort of consensus that, look, there is Goldilocks macro at this point, by which I mean that inflation, the underlying inflation is sort of under control, and growth seems to be fine, at least in terms of the headline numbers. So the need for the MPC to disturb the status quo is not quite there at this point.
Perfect. You mentioned a very interesting phrase there, a Goldilocks situation on interest rates. Before we touch base, or before we elaborate more on that point, how do you expect that the whole interest rate scenario is going to pan out for the whole of 2024? What is your expectation? Or if not for the whole year, at least maybe June, July, because we'd have seen 2 festive seasons, a new year, a sober new year, and then life as normal.
So, I mean, so first thing, Goldilocks, what I wanted to sort of put out is not Goldilocks interest rates, but rather Goldilocks macros. So our Goldilocks macro situation is when you have the best of worlds. So your inflation is pretty much under control, and your growth is fine. That's the best scenario. The bad scenarios are when either of them start showing signs of stress. And obviously the worst scenario, and I'm not sure we've selected a Disney character for this, but for that scenario, we have when both growth is falling and inflation is elevated. So look, I mean, in terms of where we see the growth cycle, I think for FY24, we think it's going to be around 5.9%. Now, this is below the RBI 6.5% number. In the near term, I think growth looks pretty fine. I mean, it rose to around 7.8% in the first quarter of the fiscal year. The second quarter is also likely to see robust growth. But I think so there are a few headwinds there. One is the fact that consumption seems to be a bit skewed, in the sense that, and you see this a lot in the data that you get, that say for instance SUV sales doing well, which are frequented by sort of people with better incomes at the top of the pyramid, while small entry-level cars and two-wheelers have been struggling. Even in the sort of rural indicators are yet to kind of reach the kind of recovery that the swift recovery that people were expecting. Plus, I mean, let's not discount the fact that we've had a really erratic phase of monsoons, even though you might argue that overall monsoon has been much better than earlier anticipated. But the funny thing about or the weird thing about monsoons is that if it's not uniform, or if it
Then,
doesn't rain at the time it's supposed to rain, that also
yes,
causes disruptions. I mean, what's happening to onion prices today is a reflection of late monsoons. So
yes,
the kharif crop is yet to enter the market. So in those perspectives, whenever you have a sort of bad spell of monsoons, and your sort of sowing starts getting impacted, then that has an impact on rural demand too. On the investment side, the government has been very aggressively spending. I mean, the fiscal numbers that we sort of see every month seem to show that it's all engines blasting. So they're certainly doing a great job there. I think the question sort of which often one has is that how much of this is really driven by government, and how much
yes,
of it is the private capex coming up? Because when government capex starts slowing, let's say we are coming to the end of the year, we are entering into elections, then how much would private capex kind of support that? And over and above all of this is the fact that you have a very weak global
mm,
situation. I mean, and you alluded to this before, which is that we have sort of reached interest rates globally where probably a generation has never seen such high interest rates,
very
right?
true. Yeah,
And the open question at this point is how these economies would react to these interest rates, how fast inflation will come under control, how durably inflation will come under control,
yes,
what would happen to growth in these situations. I mean, for instance, despite interest rates being so high, the hard data that's coming from the US, for instance, is pretty okay. It's actually quite healthy. So the question then that the Fed has is, should I hike more or not? So the point is that
mm,
you've spent the whole of this year tightening the screws of monetary policy, right? And the message, the sort of consistent message that we are getting from global central banks, and as a matter of fact, also from the RBI, is that we are going to stay higher for longer because
for
they
long.
clearly see inflation as a problem. So then the next question is, if that is indeed going to be the case, if central banks are going to stay higher for longer, then what would be the impact of that on the economy, on growth? How fast or slow will the growth slow down? I mean, the sort of common parlance which is used in markets is it going to be a soft landing or a hard landing? I mean, who
Yes,
knows? It could be a crash landing for all you know.
crash
So
landing.
you don't know, and I think this it's a very uncertain global environment, right? And
Actually brings me to one of the doubts, one of the questions that I've been having for a very long time, and me waiting to ask. When there's so much uncertainty around us, did we take a very early call in pausing rates? Should we have been with the flow, gone with the flow? Maybe if not 25 dips, India by now, we're very used to doing a 45, 35, every number possible. Should we have done something innovative like that? Just keep the momentum going instead of taking a long pause, a pre-warranted long pause, or a much earlier judged long pause.
I mean, look, I don't think so. And that is
Okay.
primarily because ultimately the RBI is a flexible inflation targeting central bank. It's not a currency targeting central bank. So
Hmm.
presumably the argument that you have is that, well, the rates differential is sort of getting lower. But the point
Yes.
is that RBI is not in the defense of the currency with interest rates. For that, you have forex reserves. Right. So I mean, and I think it's important, and which is what the governor keeps saying in many forums. And I think at one point, I'm sure there'll be a level of, frustration that markets don't accept as cleanly. What he's trying to say is that, look, we intervene based on volatility in the forex markets. We obviously look at all the global factors, but we react to domestic factors. And I think that is exactly what a flexible inflation targeting central banker ought to be doing. So I think it's on point there. Our growth has been doing okay for now, right? And but there are, as we just discussed, there are certain vulnerabilities within the growth story. Even if the RBI sort of has a 6.5% projection for FY24, I think there are these concerns, of course, in the market. And
Hmm.
apart from that, I mean, let's look at inflation. Inflation has been moderating. Core inflation has been moderating. The sequential momentum in core inflation, right, has come off quite sharply. And probably, I mean, in a long time, we've seen such sort of rapid fall. And part of it is because input costs have come off quite a lot. right? So
Yes.
input costs have come down. So goods are the core goods for is sort of reacting lower to it. So in such a situation, the RBI, I think the RBI has timed this perfectly. I mean, in the sense that, and the point is that, look, the RBI is not saying that our guard is down. It's sort of not saying that it's over tomorrow if inflation
Yes.
pressures start to pick. I mean, by the way, our stance is still withdrawal of accommodation, which technically means, so it's not neutral, right? So neutral would mean I can either hike or cut. Withdrawal of accommodation essentially means that, well, I'm still tending towards the side of aggressive of hiking. So I think the RBI is sort of in a point where they've said, okay, we've hiked quite a lot, right? My growth is stable for now. So it's fine. I am yet to see or I am currently seeing the transmission of higher interest rates
Okay.
within the system, and by I mean sort of, as the RBI,
Reserve Bank.
and my inflation, the core inflation is moderating, and my inflation expectations are coming down. And after all, I would raise interest rates to control that, so that is still under control. So and I agree that it could be that there are upside risks to inflation, but for that I am communicating to markets that we are going to be nimble, we are going to be alert. So as of now, I think that given our growth inflation metrics, we are fine pausing. I think that is a good policy to have.
Perfect. And on that note, do you also believe that rates are here to stay at 6.5 for a long time, maybe till June, July next year? You don't expect, you're ruling out another hike, if at all, because global markets are continuing to hike a little.
Yeah, but again, see, if you hike along with global central banks, right, then essentially you're hiking to control the currency.
Okay.
And I mean, the interest rate, foreign inflows coming into India, interest rate is just one of the many factors that are in their sort of purview. So it's not no guarantee, for instance, that you'd say, okay, I would raise interest rates and definitely I will see an impact on currency. But more importantly, the priorities will be completely at loss if the RBI decides to use interest rates to defend currency, and especially at a time when your forex reserves, you've got decent forex reserves. So, why not? There are many lines of defense before you even think of dismantling the whole policy setup. I think we are in a point of long pause as opposed to any further hikes, given where we are forecasting growth and inflation. We do think that once the growth cycle kind of turns, and once maybe indicators on the growth side start to weaken, and inflation sort of remains under control, the underlying inflation remains capped, then the RBI might sort of move or get more confidence to get into sort of a cut zone next year. So yeah, so we have our first cut so far. Our base case is it's penciled for April, and then we have 100 basis points of cut next year in our baseline scenario. But on the hike side,
When
I
are
think
you
we have sort of
projecting for the cut? Any timeline that you're having for the cut to
yeah.
come through?
So as of now, we are thinking of April as the first cut.
That's not far from now at all.
That is not far from now, especially when time goes so fast. Yeah.
Yeah, right. And I take your point on the factor that interest rates is just a component of flows. It's not a determinant of flows. I completely take it. But we very recently say that, the current quarter GDP number should surprise us positively. You read numbers day in and day out. Are you seeing signs of it? Are you seeing signs of being positively surprised? A Diwali surprise from the economy before Diwali?
Yeah, I mean, the high frequency data has been coming out pretty strong. So there's no doubt about that. I mean, you could question in terms of, the nuances which we discussed earlier. But notwithstanding that, if you just look at the headline numbers, it's been pretty good. I mean, we've had sort of decent sales numbers for, at least for passenger cars. We've sort of seen, at least in August, we saw very good performance for merchandise trade, although in September it kind of moderated. So September numbers are a little duller compared to August, right? But if you compare the average of the quarter July, August, September, and you compare that with April, May, June, we seem to be at a healthy place. The industrial sector is doing pretty well. The recent core sector numbers have been pretty good. So all things put together, I won't be surprised if the number that comes in for the next quarter is strong. I mean, look, there is always an element of uncertainty because even in the last quarter, there was a big component of the GDP growth side,
Yes.
which was just statistical discrepancies, right? So
Yes.
and obviously the way it works is that you've got a GVA, which is agri industry services, and then you try to match that number with consumption, investment, government spending, net exports, and whatever is not explained for then is sort of attributed to statistical discrepancy, and then later you come up with that is sort of reconciled over time. But the point is that when there is such a high statistical when is there such a high discrepancy component, I mean, it does, as forecasters, it makes it a little tricky to figure out, well, okay, what's going to happen next, because for all you know, because that discrepancy is not in the air, right? It is either part of consumption, or it's part of government spending, or it's part of something which is not being captured, right? So there is a level of uncertainty which is there. But that said, I mean, the general indicators per se seems to show good momentum. Governor Das, in a recent media interaction, seems to say that he is looking at upside surprise to that number.
Yes.
And I mean, to give credit to the RBI, they've actually done a very good job in terms of forecasting growth in recent times. So I wouldn't be surprised. I don't think that the high frequency indicators sort of tell you a different story to that. So we should be getting a decently good quarter.
Perfect. Just staying put on interest rates, one other thing that interest rates sort of get managed with is the flows in the country, the domestic currency flows, currency circulation, etc. That has been a little on the low side, but it's not having a subsequent implication on the demand for money. That mismatch is somewhere still there. Do you see that getting bridged, getting gap down? And do you see interest rates playing a part in doing that particular job?
I mean, presumably you're talking of currency in circulation. Now, typically in festive times, CIC does come under pressure because people end up sort of using a lot of money to spend, sort of using cash to spend. But look, I mean, one of the things the RBI did in its October policy is this whole thing of we could do OMO sales, right?
Yes.
And the whole idea of that is that you suck out some of the liquidity in the system. So you really want liquidity to be lower. Now, the reason why this was quite surprising for the markets is because markets felt that if you kind of play around with the numbers, then liquidity is likely to be under pressure in the coming months, which sort of beg the question, when and what trigger will be required for the RBI to